Hi, this is Lara at Elliott Wave Stock Market. After the New York sessions closed for the 26th of October, I'm going to look at three historic examples of market crashes. I'm looking at the S&P 500, and I'm going to have a look at the indicators that I use on a daily and weekly basis at Elliott Wave Stock Market, and try and have a look and see could those indicators have been any use in anticipating those big market crashes in 1987, 2000 and 2007. Let's start at the beginning with 1987. Let's make this a lot bigger. This is a weekly chart of the S&P 500 going back to February 1987. This vertical line shows the final high in August 1987, and then we have this crash, the flash crash here in October. So we had the high, the price high, a few weeks beforehand. This is a weekly chart. There was a hanging man candlestick pattern on the week just before the high, and then we had some bearish confirmation of that candlestick pattern in the following weekly candlestick. A hanging man is a good reversal pattern when it comes with bearish confirmation, because the bullishness of the long lower wick of the hanging man candlestick requires that bearish confirmation, and we got it that next week. So that was an indication that a high was in place, but it doesn't tell us if the trend is going to change from up to down or up to sideways. So it was a warning of a potential change, or at least price could be moving into a consolidation. At the high, the moving averages, I've got a short-term 13-week, a mid-term 21-week, and a long-term 40-week, which is equivalent to the 200-day moving average. This guy had a full-bore bullish look. They all had a positive slope, and price was above all three, so they gave no warning at all. ADX at the high indicated an upward trend which had further room to run, so that gave no warning. We did have a warning here from RSI, had good long-term divergence, single here, and then a second double divergence developed at the final high. So that was a reasonable warning of a possible trend change. That, in conjunction with the candlestick pattern, should have been signalling quite strong warnings. Stochastics didn't know. It had only very slight weak bearish divergence, and MACD was fully bullish at the high. Stock charts don't provide volume data this far back, so I can't look at on-balance volume, which is one of my preferred indicators. Let's have a look at the daily data. For 1987, the price high came on the 25th of August, and this is the crash here in October 1987. So the high was actually a few weeks prior. At this high, ADX did offer a warning. It had reached extreme. It was above both directional lines, and then as price made its final high, the ADX line started to decline, saying that price was probably moving into a consolidation, and it did consolidate for a few weeks. RSI at the daily and weekly chart did offer some warning at the high in August. This is double bearish divergence and a failure swing. Very nice to see when those happen. That happened at the final high on the 25th of August. And Stochastics offered a weak bearish divergence, to a little bit of a warning. MACD was not fully bullish at the high, so there was a little bit of a warning that something might have been about to happen. Not a warning that this could have been happening, but that at least price was going to perhaps turn for a deep pullback, or maybe just move into a consolidation, and we did get some consolidation. On this day here, the short-term moving average crossed below the mid-term moving average, and price was below both. That indicated that a mid-term pullback should have been underway. So that should have indicated for mid-term traders either to exit and hold cash or to be short the market, and that would have been a timely warning before the crash. ADX also, before the crash, did indicate a downwards trend in place. ATR was showing a little bit of an increase. RSI wasn't oversold, so there was room for price to fall, and Stochastics had only just moved into oversold, so there was again room for price to fall. And MACD, just before the flash crash, was again fully bearish on the 8th of October, so that was a nice warning. So by the time we got down to this point, there would have been enough warning signs of something possibly about to happen. But let's look at the AD line, because this actually gives the best warning of all. At the high in August, there was double bearish divergence over 4.5 months between price as it made its final high and the AD line, which here and then the second divergence here failed to make a final high along with price. So this upward movement in price did not have support from market breadth over a period of over 4.5 months. So that was a strong warning that there was weakness in price and it was susceptible to a pullback or a trend change. Let's take a look now at the next historical example. We're going back to the year 2000. This candlestick here has the high, it has a longer upper wick. 2 weeks later, we had a candlestick reversal pattern with a very long lower wick, and it had very, very strong bearish confirmation the very next week. So this was a very strong signal with this very strong bearish candlestick pattern that something big could have been about to happen, or at least a trend change. This should have switched from neutral to bearish for traders. At the high, there was no warning from volume. Rising volume supported the rise in price, and afterward, as we started to move away from the high, there was some decline in volume. There wasn't a good support from volume at the early stages of that bear market of the dot-com crash. There were bullish signals up prior to the high. A false bearish signal here was quickly negated. This is the dangerous aspect of on-balance volume, the thing to be aware of. Sometimes it can do this. It can give a bearish or bullish signal and then return back above or below above resistance or back below support, negating that signal quite quickly. There was another false bullish signal here, very quickly negated the following week though. And here's a bearish signal which was not negated, so that came shortly after the high in this weekly candlestick here, so not too long after. On balance volume gave a reasonably timely signal. At the high, ADX did indicate an upward trend which was not extreme, and this is actually the strongest signal ADX can give when it's above 15 and starts to rise, and it's coming up from below both directional lines. That's the strongest signal it can give. It tells us that there's an upward trend here in its early stages, so that was of no use whatsoever. RSI gave no warning though, and it wasn't even overbought at the high, so this would have told us that there was room still for price to rise, and along with ADX looking bullish, that could have been quite bullish. There was, however, divergence between stochastics and price at the final high, but MACD also gave a bullish crossover, so really not much to be concerned about here except for this big bearish candlestick pattern following the hanging man. That would have been the strongest warning. But what about the daily chart? What did that show? This also had a candlestick reversal pattern at the final high, an evening doji star. At the final high also, the last few days of upward movement came on declining volume, and then afterward for some of these red daily candlesticks there was support from volume for the fall in price, and we had a very, very strong day. The strongest volume day here is a downward day. Well, the balance of volume is down, and it showed a very strong increase to support downward movement within that session. On balance volume was giving bullish signals here and here, a break above resistance, a test of support, and moving up higher, so there were only bullish signals from on balance volume prior to the high. But here it gives its first bearish signal very soon after, in one of these early days down here. A bearish signal from on balance volume would have been a good warning, along with rising volume and falling price to support. Rising volume supported the fall in price. ADX here indicates an upward trend which is not extreme. It's coming up again from below both directional lines, so this is a strong signal of an upward trend up toward the final high. RSI only just overbought. It did exhibit very, very weak longer-term divergence between price, but that would have probably been too weak to have taken much notice of it, and no warning from stochastics, no warning from MACD at all. What about the AD line? This one is the starkest of all of the charts that I've got in this article. This offered some really, really strong, clear and persistent bearish divergence with price. As price rose up to the final high on the 24th of August 2000, it came with very strong multi-month divergence with the AD line. Now that's not a very good timing tool. It just tells us to be aware that the rise in price does not have support from market breadth. It's quite weak and it's susceptible to a trend change. And then we look at other indicators and signals to see when we've had that trend change. They don't usually come until after a little while after the trend change. Okay, let's take a look at the next example. We're going a little further forward in time. We're going to 2007. We're going to look at the S&P 500 on a weekly chart first. This is the high in October 2007. The first warning that something might have been about to change would have been this very, very strong bearish engulfing candlestick pattern after the weekly candlestick that had the final high. Up to the final high, there was rising price which came on falling volume. So this rise in price did not have support from volume, and so it should have been approached with some suspicion. No warning from moving averages though. At the high, the moving averages were full ball bullish, short term above, mid term above, long term, and price above all three. The signals from on-balance volume given up prior to the high were only bullish. We have the first bearish signal not until this weekly candlestick here. This one here. It comes, interestingly, before we have a new major swing low. So if you're using Dow theory, that would have come a little bit later after the signal from on-balance volume. We get a strong or a reasonably strong bearish signal from on-balance volume when it moves below this yellow support line here. At the high, there was a warning from ADX. It had reached extreme for the upward trend, and for several weeks, in fact, for over 2 or 3 months, the ADX line had been declining, not consistently, but mostly declining for most of that time. And so this upward trend had been quite extreme. By the time we get up to here and ADX is still declining, it's telling us that there's quite a lot of weakness here in this trend. And here, ADX moves above 15, it's rising, it's coming up from a low level, it gets above 15, so now we could possibly have a trend, and it's coming up below both directional lines. Here, it's giving a very, very strong signal on this weekly candlestick here that we may now have a downward trend in place, and again, that comes before we get a new major swing low. So there were warning signs after the high, not before the high, but not too long after. At the high, RSI did offer a weak bearish signal. I don't like to use these longer term divergences with RSI because sometimes they just disappear. So when you see them in conjunction with a bunch of other signals, then you give it a little bit of weight. On this point here, because ADX had reached extreme and was declining for such a long time, then maybe RSI should have been given a little bit of weight here, approaching that final high. Also, stochastics offering some bearish signals. A bearish crossover here from MACD, but a bullish crossover here, now a full ball bullish look. Another bearish crossover, and it doesn't move into full ball bearishness until we get into this weekly candlestick here. So again, by the time we get into this point here, everything would have been looking very, very bearish just a few short weeks after the final high. What about the daily chart level? Here's the high on the 11th of October 2007. There was a bearish engulfing candlestick after a hanging man. So again, there was a hanging man with the long lower wick of a hanging man offering some bullishness. It needs a bearish confirmation in the following candlestick. We got that on the very next day. So there's a reversal pattern here at the high. As price rises to the final high, it comes on declining volume, but the moving averages at the high are full ball bullish, short term above, mid term above, long term, prices above all three. Only bullish signals from on-balance volume prior to the high. Here's the first bearish signal on the 16th of October 2007, the next on the 18th of October, and after that on the 8th of November. So a little cluster of bearish signals here from on-balance volume. By the time we get to this candlestick here, we know that something might have changed. It would look quite likely at this point that something might have changed and something might be different. And now we get increasing ADX, and it's coming from below both directional lines. It's rising. The negative directional line is above the positive. So at this point here, things start to look quite bearish. The fall in price comes with a rise in ATR to support the fall in price. RSI not oversold, so there would have been room for price to fall. Stochastics not oversold, now moving into oversold, didn't exhibit divergence at these lows, and here MACD moves into a full bore bearish look. At the high, though, it was still full bore bullish. Stochastics only exhibited the weakest of warnings, and RSI didn't even reach overbought. So not a lot of warning prior to the high, only a little bit of weakness in volume, but no other warnings. But we do get some warnings after the high in a fairly timely manner. But what about the AD line? Again, this is the only one in all three of these examples, again, that offers a timely warning. Not a timely warning because it's not actually very good in timing a turn, but it is good in telling us in the months approaching a high that there is some very serious weakness in the market. As price rose to this high and then this high, the AD line made a lower high and another lower high. So some good, clear, strong double bearish divergence between price and market breadth. The rise in price up to this final high in 2007 did not come with support from market breadth. There was quite a lot of weakness up to that high, and so after that, when we then start to get that little cluster of bearish signals from on-balance volume and some bearishness in ADX, that would have been enough to tell us that something bigger, a downward trend and not just a pullback or consolidation, perhaps a trend change, could have been underway. So the conclusion has to be there are warning signs. The AD line will give a warning sign. It's not useful in timing a market turn. It's only a warning sign, and we need to let that divergence develop over at least 4 months to 6 months, which is exactly what Lowry's say they've seen for the last 92 years. At this point in time, we have an absence of all of those signals currently in the market, so I do not see a reason to be bearish. I see every reason at this stage to remain bullish. That doesn't mean a bear market can't happen. It just means the probability of it at this stage with the data in hand does look to be quite low. That's all from me with your extra video update, and I hope all of our members and viewers are having a most fabulous day.